please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Taking Stock, the show where we take stock of the week gone by and prep you up for the one that's lined up ahead. I'm Surabhi Upadhyay and with me is Prashant Nair. Hi Prashant, I thought it was a very, very interesting week, one that literally bored us out from Monday till Thursday, and then Friday perhaps gave the feeling, at least to me, that the bulls definitely seem to be having a bit of an upper hand. So let's just pull up actually the intraday graph, or rather the weekly chart of the Nifty as well. Inching baby steps on a daily basis, but then trying to get back towards those levels of 10,400. That's what the journey was really all about. And perhaps the heartening fact was that the mid-cap market was in good flourish, because that index actually hit an all-time high on Friday. What have been the big takeaways for you this week?
I mean, I think, there was too much activity, I guess, last week. Because, I mean, last week we had, just to compress this in two simple numbers, last week we had almost a 350 odd point move from last week's high to last week's low. Yeah. This week that number is under 200 points. So, I mean, it was just a smaller week in terms of just the gaps. I mean, both on the upside and the downside. And last week we had two 200-point moves. One first down, Monday, Tuesday, Thursday, Friday, 200 points up. So nothing of that sort this one. But I don't think anything to really complain, because we basically end the week with a 1% gain, which is pretty good. The Nifty basically has recovered 300 of the 400 points it lost. The Nifty lost about 400 points in about 7 or 8 trading sessions. That was the week before last. The last week, actually. I mean, the correction stopped on Tuesday. Tuesday basically was the bottom. From there, the market is up 300 points. So there is only 100 points between where we are now and a new all-time high for the Nifty. I mean, the news for the Bank Nifty, the mid-cap index, etc., I mean, actually is even better. The mid-cap index made a new all-time high this week. The Nifty Bank is just 130, 140 points away from a new lifetime high. So, and as you said, I think a nothing kind of a week, really. I mean, you could pay attention to all kinds of news flow, but the really big one, of course, was what happened last week with that upgrade which came through. So this was, I guess, a week where some of those gains were digested. Yeah,
I think this was this week was a lot about the moral debate between shouldn't promoters be allowed, and I think the final answer that we got is no free lunch. If you're not paying up for your past dues, you can't go and buy back or try to buy back your own company. That was a big talking point throughout the week. Anyhow, let's now introduce our guests. So joining us on the show to discuss the week gone by and the triggers forward is Tushar Pradhan, CIO of HSBC Global Asset Management. Tushar, pleasure speaking to you on the show. So let's ask that basic question to you. We've had this range-bound sort of, stay, maybe just a 3% dip from the top. Does the market now look strong enough to you to take out previous highs and maybe make fresh ones?
Very difficult for me to call that, because I'm not an analyst of prices. But I think when I look at the economy in general, I think what is very clear is that we believe that the earnings which were expected to come in this year haven't come in till the second quarter of this financial year. The expectation is that earnings will start to build momentum into the third and the fourth quarter of this financial year, ending in March next year. And we believe that that will give a lot of confidence to the market to say that, yes, the recovery through the economic cycle is there. And that might be, enough cues for the market to take it further from here. So I think the focus on earnings is clearly there. And that's something that we would like to see very closely, whether that actually gets delivered or not.
Tushar, hi. I might be nitpicking a little bit here, but does it seem like at higher levels the market is finding it a bit difficult to sort of go on? And I'm not asking you to tell us what prices will do next week, but essentially your analysis. Is this all set for more gains as we go along at an aggregate market level, or is it seeming tired? I mean, after the rally we've had, it could be valuations, it could be higher oil prices, it could be all this paper which has been hitting the market. Your sense?
Yeah, I think we are in for a fairly interesting time, because there have been two distinct, contributors to the returns. One has been liquidity, and more importantly, domestic liquidity. What we have seen in the past that whenever there is international liquidity coming into the markets, especially through the FPI route, we find that the market is highly correlated to these inflows. And for the first time this year, we've seen that while the FPI numbers actually remain fairly tepid, in fact even negative for some months, because of the domestic liquidity which continued to pour in, we saw the market continue to go to new highs. I don't think the domestic liquidity situation is going to change too much, which means I continue to believe that domestic liquidity will remain strong. But if you look at what has happened in this month so far, there has been a marked difference in terms of how the FPI inflows have worked out. Almost about $2.5 billion in the month alone on a net inflow basis into India, not only through Asia-oriented or regional funds, but even India-oriented funds has seen some kind of inflows. So I think if I put these two things together and say, look, has the outlook for India investing abroad changed, and do they think that India is a bright spot? If that is an affirmative, then I think we will have, in addition to domestic liquidity, even international liquidity going into the market. And that makes for a very interesting time for markets. However, if this is again kind of buttressed by the fact that earnings also are growing, then you will get even more attention into the market. So I think overall, I remain fairly constructive throughout this period into the next year.
Tushar, let's get your view on then the big story of the week, and that is the amendment to the IBC, the bankruptcy code. Now, I mean, the debate is still on whether in the near term this will mean that banks have to take higher haircuts because in all probability promoters won't participate. What would that mean for some of the larger corporate lenders, and what sort of banks are you comfortable holding now?
Well, actually, it is not something which can be easily ascertained at the moment, and the level of haircuts again depends on what sort of alternatives are available, right? So, for example, if the existing promoter is not, allowed to come back in, then it depends on how many people actually find an asset attractive, and the haircut is dependent on that, right? So, in a sense, it's not a very blanket case to say yes or no. I think assets which are very attractive to certain bidders will clearly find some interest, and then that is a lesser haircut for the lending bank to take, and probably a better exposure to take versus the older promoter. So that's actually positive on the margin. Wherever there is lack of demand for the asset, I think the market will find its own level, and that's the level of haircut that any bank is likely to take. So it is very difficult to complicate this to say, well, will this bank do well or that bank will do well? I think it will all depend on individual assets, especially the exposures in the more sensitive sectors such as power and steel to a certain extent, and within those sectors which are a better asset to be bidding for, and so on and so forth. So it's really very stock specific, not only stock specific as in the account specific, but even banks which have lent to these kind of accounts. Very difficult to call. We still believe that corporate lenders will find it tough. However, the sentiment has changed. So what we have seen already is that the sentiment having changed, there has been a substantial upgradation in the valuation that the market is willing to give to them. But are they out of the woods yet? We don't even know how many of them will be out and what the impact will be. So I would still be wary of saying, well, is this an exciting market to get involved with? I think one should take a very stock specific view on this, do your in-depth research and decide whether any one corporate lender over the other has any benefit or advantage, and maybe that's the one to call, because clearly things are going to improve dramatically for such banks.
Tushar, so in a way you're saying the time for sector calls is kind of behind. I mean, at an aggregate level, it's tough to justify valuations, but I mean, you could still find stocks.
No, in fact, valuations are in your favor, right? So, for example, when you look at corporate banks and where their valuations are, they're clearly at a discount to private banks as well as NBFCs, correct? So, in that sense, it's not as if you're not getting any incentive to go in. You are getting these things cheap. Your way to make money here is to find out, which bank is actually going to do better through this period, and then justify the valuation and actually get re-rated, because we are talking about an asset book which will suddenly turn out to be a lot better than what most people expect. And there you will get a valuation increase which is very sharp and quick. and it will settle to a much higher valuation level than here. So that's your opportunity. It's not about growth, it's not about how this bank will grow, etc. It is about how it will manage this bad asset situation. So I think there is a selective opportunity there, and as I said, I think if you take a fringe position and you bet on a few things which you know well, I think there is a chance that you'll make money here as well.
Tushar, when we talk of risks, obviously oil is a factor that no one can afford to ignore. I mean, that's constantly on our radar, around 64 on Brent. How are you looking to play the oil and gas complex? What sort of stocks are you comfortable holding? I mean, things like GAIL and Reliance, for instance, have had a brilliant past 5 days. The Reliance at a 52-week high. So how do you play the oil and gas space?
Well, I think if you look at the macro winds which are flowing through the commodity cycle, you can start to see some hardening in prices across all commodities, and not in the least in crude oil as well. However, if you look at the total demand and supply situation, shale in the US continues to be a very large part of incremental capacity. If you look at what has happened so far is that we have seen some sort of reduction in global inventories, including the US inventories. And that, I think, is possibly some of the reasons why there is some hardening in the oil price. But to think that this is, more of the things yet to come from here and oil prices will, hit new highs, my opinion now, unlikely. For 2 or 3 things, around this time there is generally a seasonal uptick in terms of inventory buying prior to the winter season in the Western markets. Once all of that buying actually starts to taper off well into January, when winter is in and they're not buying any more inventory, I think that's when we'll come to see where the balance comes about. We also had a little bit of a disruption in the Middle East where due to the issues in Saudi Arabia, we had some uncertainty about the outcome of the OPEC and what they decide. But I think it's very clear that people are going to sell oil no matter what, which means that the supply pretty much remains robust throughout this period. So knowing that the world is still growing at between 2.5% to 3% across most markets, you don't need that much oil to sustain that kind of growth level. So to imagine that oil prices will again reach levels which were seen in the past, unlikely. So I would think that there is no reason to kind of worry on that account. Yes, cyclically, as you say, prices have moved up a little bit, and that will have an impact on some companies which sell oil. But I don't think this is a structural move back into very high prices for oil, at least.
Mm-hmm. I mean, Tushar, so if one looks at your fund, the assets under management on the debt side are vastly higher than what you manage on the equity side. So, I mean, you have a keen sense of what's happening there as well in the rates market, etc. Do you think interest rates have anywhere more south to go from here, or this is it? And if that is your view, that we are basically we bottomed out, what does that mean really for equity risk premium and generally what you'd be willing to pay?
Yeah, that's a very interesting question. It's a very large question, so I'll try to attempt it as quickly as possible. Basically, the equity risk premium is built on a risk-free rate and the premium that you give on that. And that is dependent on your view of what is the expected return in equities. What I would think is, in the past, what tends to happen is inflation has a fairly large impact on asset returns. And wherever inflation is very high, typically markets tend to be a little discounted than their real value. But when inflation starts to come off, like what we've seen in the past few quarters in India, the asset markets reverse and they actually pay a much higher price for the assets, because now the cash flows will be discounted at a lower rate because inflation is now in control. So that more or less explains the fact that our markets have actually become more expensive than before without an earnings uptick. What I would predict is that interest rates, when I say they have bottomed out, it means that probably the reason for them to continue going higher, will depend on the kind of growth expectations that the economy is going to give. So far, the IIP numbers don't suggest a very significant uptick. The GDP numbers are still struggling. So there is no reason to believe that interest rates are going to go up from here, because inflation also remains fairly much in control. So the reasons for interest rates to go up from here seem to be not there as much. And as if we believe that the fiscal deficit is likely to be met, the metrics, as well as in the next year probably lower and in line with the FRBM targets, then there is really no incremental pressure for rates to continue to going to go up. I am not predicting, however, on the other side that interest rates will fall dramatically and that there is a call to be made in the duration market. I think interest rates are likely to remain stable and within a range for at least the foreseeable future. That's the view.
All right, Tushar, good talking to you. Thanks very much for taking out the time and talking to us this week. That's view from HSBC Mutual Fund. We will take a quick break on that note. On the other side, we will get you all the trading tips you need to know for next week. And of course, we'll be answering your stock-specific questions as well.
Okay, welcome back. You're with us here on Taking Stock. We're looking back and more importantly, we're looking ahead in terms of what you should be doing as we come back on Monday morning. Joining us right now is Mitessh Thakkar with his view on technicals for the week. He also is, of course, going to take our questions which are coming in from you as a viewer. Mitessh, before we pose some of the viewer questions to you, just your quick take. I mean, how are we set up as we come back next week? Good for more on the higher side, or, I mean, is it becoming a bit of a struggle now?
Good evening, Prashant. I think I would possibly, if I was to cast my vote, I would say good for more. We've had a week which was subdued, which was sideways, but the closing was stronger. We also managed to get past the intraday pivots of 10,360 or there. So I think having crossed that level, I think there's a good chance that we might try and attempt the earlier highs of 10,480, 500. That should be the first weekly target for the coming week. And if we start getting past that, I think then you could see some kind of momentum, force and speed built up on the upside. For the timing, I think maintain a positive view unless until we break 10,320, 300 on the downside and use declines to buy. I think that's a good strategy. Be more stock specific given the fact that indices are still showing narrow or upward drift signs, but on a narrower basis. So I think it's just a narrowing range on the upside. And once we get past 10,500, maybe you will see some kind of short covering as well as force on the upside.
Okay, Mitessh, then let's come to trading ideas for next week. What are you working with?
See, I have a recommendation in Jan irrigation, which after a long time has started to sustain and close above levels of 110.11. So that's a buy with a stop at 108. 122 should be the first target, though I suspect eventually higher targets could happen. And Apollo Tyres, after a correction, has given signs of a short-term trend reversal for next 5 to 8 sessions. This is a buy. Keep a stop at 243 and look for 272 as the target.
All right, those are sort of recommendations from Mitessh. Let's get some questions from viewers. Twitter user Sohan Mukherjee is writing to us. He's got 100 shares of RBL Bank purchased at 522 rupees. He wants to know what he should be doing with the stock now. I mean, it's basically been between 500 and 530 for a while now after the rally that we saw in the months after the listing. But recently it's not done anything. Mitessh, what would you tell him?
I think, very clearly, if you stretch the chart a bit, starting from, June 2017, which is roughly about 6 months now, the stock is doing a range of about 545, 550 to roughly about 490, 480 on the downside. I think that range bound movement will still continue. But I think eventually with time, the stock should start breaking past 550 and that should be a start of some kind of an up move. The minimum target should be then about 600 plus. So I think I would suggest a hold, and if he wants to trade more into it, try to buy it more around the levels of 480, keep a stop below 465, and once we get past 550, 600 about 620 should be a roughly profit target.
Okay, let's move to the next query. This is from Twitter user Tejas Purohit. He has Sun Pharma shares bought at a price of 700 rupees. He wants to know whether he should buy more, average out, buy more, or simply get out. Of course, he's losing money now. Interesting query, actually. Let's get the one-year chart on Sun Pharma. The last time the share was at that level was around March, I think around March of this year, 2017. It's recovered from the lows, but still a long way off his buy price, Mitessh. What would you advise?
Yeah, so I think, in fact, instead of March 17, I think let's go back to March 15 when the stock was at about 1120, 1130 levels, and then we have seen a big correction. I think the stock is more than half. Now it's showing some signs of a reversal. I hope it sustains this time. It's had some false dawns earlier as well. But I think it looks like that this stock could now possibly get into a short to medium term uptrend. So you can buy more, keep a stop loss below levels of 495, 500. I think that being the support zone. And on the upside, I think as he gets his price down, targets could be roughly around 625, which should be closer to his average price. In case we get past 625, we can even look at 700, 710 happening. But that is something which I'll possibly know in time to come by. For the timing, I would suggest 625 should be your target, and try to add it around 520, 530 zones on a bad day when there's some kind of US FD announcement or something like that.
Okay, so let's get to the next one. Twitter user Dhruv Lathia has 1,200 shares of GMR Infra. He basically wants to know if he can hold it for the long term. I mean, the stock, by the way, was up by about 10% or so. There's no price which I think has been given here, but GMR Infra, chartically speaking, Mitessh?
A lot of these beaten down stocks, especially the infra names, JP Associates and GMR, have at least reversed from their lows, which they were trading at about a year and a half back. So in that sense, there's some kind of a medium-term up move going on. GMR possibly would suggest holding on. In case this price is closer to about 24, 24 and a half, which is my target for this entire up move, which could happen in the next few months, I think that's a good level to exit and forget about it. I don't think there's a big change happening in over here, but after having fallen from 100 plus rupees to as low as 10 rupees, I think it's just a slightly bigger bounce back.
Okay, all right, Mitessh. Really appreciate you being with us, taking all of your questions as always, as well as giving us trading advice. You have a great weekend, and we will see you again on Monday. On that note, Prashant and I will take your leave. You have a fantastic 2 days off, and of course, back with the markets on Monday.
Over the last 4 or 5 years, ever since you had a very loose monetary policy, there's significant amount of inflows to equity markets. I mean, here are some interesting statistics. More than $250 billion have come into emerging markets ever since Fed has a very loose monetary policy. So my opinion is that volatility is likely to increase as interest rates do kind of gradually rise in the developed world, and US is reaching full employment and pretty much reaching its output gap. So some amount of volatility has to rise in that context.
Well, we've got about $70 billion of inflows to emerging market product year to date. It may not feel like a great year for EM inflows to you in India because the positioning on India has adjusted somewhat more negative as people have put a lot of money into North Asia. Yeah, I mean, it's been a strong year for flows, and if you look at global investor positioning generally, they're actually neutral emerging markets in a global context for the first time since 2010. So the extreme bearishness about emerging markets of, let's say, the 2014-16 period, that's definitely gone away.
Quite constructive. I think we are at the cusp of a earnings acceleration in India. For a variety of reasons, it's been pushed back over the last 2-3 years. But this time it's for real, in my view. And so it's too early to get worried. I think we might be at a point in multiples where it's hard to get much re-rating upwards. But we should get strong earnings growth from here, and that should be reflected in returns going forward.
It's been a solid earnings season. That being said, it's not clear to me that FY18 will be a double-digit earnings growth year. We're sticking to our estimate that this is a 7-8% earnings growth year, like the preceding 4. It's FY19, the year to March 19, that we reckon that we could see our first double-digit earnings growth after 6 years. My hope is that credit offtake goes to double digits next year, say 11-12%, and on the back of that, we can get to 14-15% EPS growth in the year to March 19.